Welcome to The Explainer. Today, we're diving into a really fascinating economic idea, the theory that you, the customer, are actually one of the most powerful forces keeping the entire banking system safe. We're going to unpack the evidence and see if everyday people are truly the sheriffs of the financial world.
Okay, so let's jump right in with a question that gets to the absolute heart of this whole thing. Let's say, in a perfect world, one bank was taking huge, kind of wild risks with its money. Shouldn't that bank have to offer you a much sweeter deal, like a way higher interest rate, just to convince you to put your cash there? I mean, that's just common sense, right?
Well, that common sense idea has a name. It's called market discipline, and the theory itself is pretty elegant. It basically suggests that we, as informed customers, will vote with our wallets. We'll move our money away from reckless banks or demand they pay us more for the extra risk. And this pressure is supposed to force all banks to clean up their act. You can think of it like a giant, non-stop customer review system for the whole financial industry.
But does this beautiful theory actually hold up in the messy reality of the global economy? Do regular folks really have the information or even the incentive to act like financial detectives and police their own banks? Let's dig into the evidence. So, a 2014 study by Edgar Tovar Garcia decided to put this very theory under the microscope. He looked at data from 37 different banks in Mexico, specifically during the period of the Great Financial Crisis. And this was the perfect stress test, right? Because if there was ever a moment when depositors should have been paying super close attention to how safe their bank was, that was it. Now, here's what makes this study so interesting. It wasn't the first time this was tested. A famous earlier investigation done after Mexico's tequila crisis back in the 90s found really strong proof that depositors did in fact punish risky banks. But this new look was different. This time, there was only limited deposit insurance, which you'd think would make customers even more careful about where they stashed their money. Okay, so how is this all supposed to work in practice? The theory of market discipline isn't just some vague concept. It actually predicts 3 specific ways that customers can act as enforcers. You can think of them as the 3 punishments. So here's the theoretical toolkit that customers are supposed to have. First up, there's price punishment. You make risky banks pay you more. Second, quantity punishment. You just give them less of your money. And third, what's called maturity punishment. You keep your money on a much shorter leash, maybe by moving it from a long-term CD to a short-term account, so you can yank it out in a hurry if things start to look shaky.
So what happened when the researchers actually went looking for these 3 punishments in the real-world data? Did the theory hold up? Well, the verdict was, let's just say it got complicated fast. Let's start with that first one, price punishment. The results were immediately kind of weird. I mean, yeah, banks with a higher overall risk of just plain failing did pay a little bit more. But the data also showed that banks with bad management and low-quality assets, we're talking bad loans, were bizarrely rewarded. They actually got away with paying lower interest rates. That is the exact opposite of what the theory predicts. And the contradictions just kept coming when they looked at quantity punishment. On one hand, sure, safer banks with more capital did attract more money, just like the theory says they should, but so did banks with major problems. Banks that were inefficient, that had liquidity issues, meaning they might not have enough cash on hand, they also saw their deposits grow. It's like depositors were rewarding both good and bad behavior at the exact same time. So across the whole system, the results were just weak and mixed. In the author's own words, it looked like banks could actually counterattack market discipline. What does that mean? Well, for example, a bank might get punished with higher interest rates because it has low capital, but then it could just make up for it by attracting more long-term deposits anyway, basically canceling out the punishment. But just when the case seemed to be going cold, the investigation uncovered a huge plot twist. The researchers decided, okay, let's stop looking at the entire market, and instead they broke it down, comparing different types of banks against each other. And that is when things got really interesting. First, they had to acknowledge a really important feature of this market. It was incredibly concentrated. We're talking just 7 massive banks, which the study calls the G7, controlled about 85% of all customer deposits in the whole country. This is not a market of equals. It's a market of giants and then everybody else. And this is where the theory just completely fell apart. When the researchers tried to find evidence of market discipline within these groups, so for example, comparing one giant G7 bank against another giant G7 bank, the statistical models, and this is a quote from the study, lost meaning. The signals for discipline they weren't there. They vanished. Which led to this one
Final, stark conclusion. Market discipline was completely absent inside these different market sectors. Look, a customer might choose a giant, well-known bank over a small, unfamiliar one. But when it came to choosing between two of those giants, they didn't seem to be punishing the riskier one or rewarding the safer one. Among their direct competitors, the discipline just wasn't there.
Now, this isn't just some dusty academic debate. The fact that this theory seems to break down has enormous real-world consequences for the safety of our money and the stability of the entire financial system.
So what does this all mean for us? Well, the study leaves us with some pretty critical takeaways. First, there's probably an unspoken too-big-to-fail policy going on. People just assume the giant banks are safe, so why bother checking up on them? Second, when there isn't real competition, customers just don't have enough meaningful choices to enforce any discipline. But the biggest takeaway is this: we can't just rely on the market to police itself. That means the burden of monitoring risk falls squarely back on the shoulders of official regulators. And that leaves us with a final, pretty provocative question. We started out by asking if you, the customer, are the real police of the banking world. The evidence here suggests, well, maybe not so much. So if the wisdom of the crowd isn't enough to keep the banks in line, who is? And in the next crisis, is their oversight really going to be enough?